Hey guys, welcome to this week's podcast episode. I've got a really fantastic guest with us today, Tom Chase. We're both traveling, so kind of keep that in mind. But he's actually got a very fascinating story, kind of story of pivoting at the end of a corporate career. He's a co-founder and CEO. He's going to talk all about passive investments, real estate, um, equities, kind of the bread and butter topics for the audience. And I'm happy to have him on the show. So, Tom, welcome.
Thank you so much, Chris. I'm glad to be here. I appreciate it.
Yeah, you're the co-founder and CEO of Affordable Housing Loans and the Passive Income Network. And so kind of you're in this bread and butter business where a lot of high income professionals are interested in investments for passive income, for tax advantages, and strategies. Talk about your backstory, your background, and we'll dive right into it.
Okay, great. Well, as a lot of things happen, we have pivotal moments in our life, right? So, so I had one of those pivotal moments in 2011 is when this started. I was still in corporate America. I was at mid high level management, and it happened. My wife and I were on vacation, and my phone rang, and I remember looking down, and it was our executive VP, and I said, "Well, he knows I'm on vacation. This must be important." So he was calling me to let me know there was going to be an announcement the next day that our company had been purchased. And he did that for a couple of reasons. He knew I had been through the same scenario twice before in 12 years. And he wanted to make sure I stuck around because there was going to be a transition period of about a year. So he wanted to make sure I stuck around for that. So he called me to let me know, didn't want me to be surprised, and said, "Look, if you stick around and help us through this, we'll pay you a bonus." I would have done it for him just because of him. I respected him that much. But that pivotal moment got me thinking, okay, I was at the point in life where, yeah, I could go somewhere else and get another job. But I was also at that age where a lot of people are going to look at me, why should I hire this guy? You know, I didn't want to relocate from beautiful Arizona where I live. So when my wife and I got home from that trip, we had one of those tough conversations around the dining room table. I won't go into all the detail, but basically it was, you know what, I'm too young to retire, and we're not in the financial shape we need to be to retire the way we want. And the conversation was around that. And I had done some real estate investing, small time landlord, owned a few rental homes. Did not like the fact of being a landlord because of the cost and the associates and the stopped up toilets and the air conditioning not working and things like that you had to deal with. So I got to thinking, I've got to figure out what I'm going to do with the rest of my career. And really, in the whole real estate arena, the thing I liked best was being the bank. In other words, when the toilet stops up or the air conditioning stops, they don't call the bank. You're just the finance person. And I like that because it's income coming in every month, and my investment is secured by a hard asset that if someone doesn't keep that promise to pay, we've got a hard asset. And so that led me into the business I'm in today. And that was 2012 when finally that year was over. We had the transition. The company I've been with paid me to stay. They paid me a bonus. Then the other people paid me to leave. We started out in the business then. When I say we, I'm talking about me and my wife, but it's basically it was me. And I like the fact of buying and investing in real estate notes, okay, and notes being promissory note, basically. So when I started out, I wanted to tiptoe into it, and I started working with what's called hard money lenders. They lend to guys who buy homes and fix them up, rehab them, and resell them. So I was buying those loans short term and giving a nice return on my money, 10 to 12%. And I like that. So that led me, I won't go through the whole story, but led me into, I wanted to grow this business. I wanted to buy more notes secured by real estate. Well, at some point, you run out of your own money, right? And it happened to be that my first investor that came with me was my brother-in-law. We were out to dinner one night. He's like, "What are you doing? And tell me about that. And how does it work?" And when I told him, he said, "Wow, can I get in on this?" And so I started working with other investors because people in my age group, the baby boomer group, there's been a number of studies done by like Alliance Insurance Company, Financial Advisor, Yahoo Money, that most of us worry more about running out of money in retirement than we do about dying, you know. And because a lot of us don't want to deal with the volatility of the stock market and things like that. So, and that's where I was, and I found a lot of my peers in my baby boomer group felt the same way. So we started getting more investors that came with us to start investing in these kind of notes. As things, because I'm very conservative, I only stayed in my local market in Arizona. I wouldn't go buy something in a market in, say, Georgia that I knew nothing about the market, didn't have boots on the ground. But it got harder and harder to find good notes to buy. And when you're buying a note somebody else is selling, you really got to do your due diligence, because most people don't sell their best notes. So there's a reason. And I started thinking at that time, this was a 2016 timeframe, I started thinking about, how do I think like a manufacturer, create my own product instead of going and buying product. And at that time, I was a licensed mortgage loan originator. I am a licensed mortgage broker today, too. So I have those licenses back behind. And about the same time I was thinking about this, I bought my first note on a manufactured home that was in a community where you don't own the land. The loan is only on the home. They're called land leased communities. So the people pay lot rent and pay for the amenities in the community, but they own their home. And I really liked it that I could buy 3 or 4 notes for the same dollar I was buying a real estate note, and I could get a little higher return. And I talked to some of my investors, and they said, hey, this looks really good, and we like it too. So I did a lot of investigating into the industry, talking with some community owners, managers, finding out about the industry, about the business. And we discovered that in the lower tier at that time, like 60,000 and below, these homes were selling, there weren't a lot of lending options. And there's a couple reasons. One, when you're down on those small numbers, if you use a traditional lender's model with points and fees, you just can't make enough money. Okay. So we said, look, there's a market here that's not being served well. So let's figure out a way to serve this market. Our investors liked it. We could serve our investors better. And the communities had a lot of these homes sitting, not sold, which they weren't getting revenue for their lot rent. So it was kind of a win-win-win. So we started the company, Affordable Housing Loans, to lend in that business, focus on that niche market. And the passive income network is the funding arm and the secondary market for the notes that we create. In the world of real estate notes, most of the time people originate those loans and they sell them off to a large investor. That's their secondary market. Well, there is no real secondary market for ours. So we built that secondary market ourselves through the passive income network. And we've now been in business 6 years. We built a great reputation. Today we do business in Arizona and Nevada. We certainly have had inquiries, in fact, from the Houston area. Someone, I think you said you're from that area, the Houston area, to someone to work with that wants us to come down there. So there's a high demand for the service we provide, and the investors love it that they get passive income. So when they own a note, they own the note. We collect the payment. We make sure they get paid. We make sure they get their documents for taxes at the end of the year. We service the loan. In other words, they don't have to worry about collecting payments from anybody. We do all that for them, and it's part of their membership in the passive income network. And if something goes wrong, somebody quits paying their loan for some reason, we're going out and trying to get that loan performing again. So that's where the passive income network comes from. So hopefully I didn't take too long on that story, trying to give you the overview.
Well, what's interesting is so I love this idea of pivotal moments, and I think whether you like it or not, pretty much everybody's gonna have pivotal moments. In the past you could depend on stability, but these days nothing's gonna protect you. So one thing that's talking about is this idea of you talked about performing notes and why performing notes are great for retirement investments.
Okay, so let me give a couple things so for the people who don't know the difference between performing and non-performing. Basically, a performing note means the person that has made the promise to pay, they're making their payments every month. So you're getting the payment coming in. There are non-performing notes where people quit paying, and people who buy those for a different reason, not income. So we're talking basically about income because our investors, they want the income. The reason it's great for retirement accounts is because if someone misses a payment, doesn't make a payment, they get behind, you're not depending on that money to live up, you know. In fact, I've had investors come to us. I had one lady, she said, look, I want to become an investor in your group, and I have this much money. And she says, that's where my income comes from. And I said, well, if you're depending on that money for income, this may not work for you because the risk involved in a performing note is people get in trouble. Things happen, divorce, job losses, things like that. And they end up where they may not be able to make their payment for a few months. So with her, I said, if you're depending on that income, it probably is not for you. That's why it's great for retirement accounts. And you get a little higher return. And also there are special IRA custodians that allow you to invest in real estate in those types of markets. We have a lot of personal relationships with those custodians too. So we work closely. They know who we are.
Yeah, really interesting. And so kind of the next question is, talk about, especially in this risk environment, and you talked about, you service all the loans. What are the risks of being a private lender or owning promissory notes, and what do you do to mitigate those risks?
Okay. So the number one risk of owning a performing note, number one is the borrower quits paying. So your money doesn't come in. So how do you mitigate that risk? You mitigate it up front. Now, I'll use it with a couple of examples. So if you have a home, and we're talking about manufactured homes now, so I'm going to talk some smaller dollars. Let's say the home is worth $80,000. And the note you're holding on it is $75,000. Well, there's not a lot of equity margin in there. There's only $5,000 equity margin. So the number one is when people buy performing notes, a lot of people will sell their existing notes. They'll say, hey, the unpaid balance on this is X. So maybe the unpaid balance on that $80,000 home is $85,000. That's not a good note to buy because you don't have any equity margin to protect you. So it's buying the note right and buying it based on the value of the home. So if you have a note for $60,000 on a home that has a value of $80,000, now you got some equity margin in there. Another good thing that we do in mitigating risk is make sure you qualify the borrower. Make sure the borrower has the ability to repay the loan. That's where we got in trouble back in 2008. People were giving loans to people, if they could fog a mirror, literally, and people weren't able to make those payments. So when the Consumer Financial Protection Bureau came into effect and created what's called the Dodd-Frank laws, basically it says, hey, lender, you need to make sure before you do that loan that person has the ability to repay. Ability to repay being income, stable job, and that their debts aren't too high. So those are the ways you mitigate that risk.
Yeah, I love that. It's all about counterparty risk and essentially, basically, can the borrower repay? And that's why you have to go all through all these, background income verification, all these stuff. Which is quite interesting. The other question is one thing is the kind of next question is how are you different from other manufactured home lenders? And actually, I was actually curious, why did you choose manufactured homes to finance?
Let me answer the second question first, why we chose manufactured homes. Again, going back to that 2016 timeframe where I was looking for a way to create our own product.
Yeah.
And it just happened. I bought my first note, and then I found out there was a need in the market to be served. I think it's important. We didn't say, hey, we can make a lot of money by doing this. There was a market to be served. If you go at it like that and serve the market, serve your investors, you'll make your money. You know? And that's why we went into the manufacturing. It was a niche business that not a lot of people are involved in, to be honest. So if you're going to go play, why go play in Lake Michigan when you can play in a small pond? That's why we chose that. What was the second question? I'm sorry.
Yeah, the next question is, how are you different than other manufactured home lenders?
Okay, that's a great question because we're very proud of that. There are large players in the business. I won't mention any of their names because it probably wouldn't be appropriate, but there are some large players that lend in personal property manufactured homes. What happens generally when someone comes in to do a loan with them, the first thing they're asking is send me documents, send me do your credit report and that. And a lot of times they'll get 2, 3, 4 weeks in that process. And all of a sudden the larger lender will say, oh, wow, your debt to income ratio is out of whack. I can't do anything. So people get upset because they now have lost 2 to 3 weeks. And we hear this from a lot of our borrowers. So number one that makes us different is we're small, we're in a small market. We answer our phones. All of our phones are answered live. We have a system to make sure that those calls are routed for someone to respond as quickly as possible. And when you're working with a loan officer, you can call that loan officer directly. And the big guys, it's literally, you just got to call and get who you need and go through everything. So we're very personal. So people like that. We've also developed a pre-qualification process, literally that the first conversation we have with someone, in about 20 minutes, we can tell whether they're a good candidate for our program. And there's 3 things we look for. We talk to them, tell me about your income, what's your job, what do you do? Now again, this is all verbal. We're gonna verify that later, and we let them know that. And then second, we say we want to make sure they have the down payment. Do you have down payment? Our minimum down payment is 10%. And third, we do a quick debt to income. Tell me about your debts, tell me about your income. We do a quick calculation to see if they're close. If they can't pass those 3, we're done. We're not wasting their time. We're not wasting our time. And when I say we're done, we treat people with respect and courtesy. We say, look, here's why we can't do it. Here's some things you may be able to do to correct that. We've had people come back to us 2 and 3 years later and said, you turned me down the first time, but you helped me. And I just remember the way you treated me. And so I'm coming back to you. And then also most of our leads are referred to us by the communities themselves. And so if they got a home for sale, they want to know real quick, is this person going to qualify or not? So we can go back real quick. Sorry, they didn't pass our pre-qual, move on to your next buyer. Literally, we can tell them that the next day,
Yeah.
which is, they don't have that with other lenders. And that's why people like working with us.
Yeah.
A couple other things. We can also approve self-employed, which a lot of the big lenders don't like it if you don't have W-2. We have a way of verifying income through bank statements. And we can work with people who are tax number IDs. They don't have a social security number. We have a lot of Hispanic here in Arizona, so that they're here, they have the right to work, and they have a ITIN, which is basically so they can pay income taxes. So
Yeah. Yeah, I love that. So kind of the next question is, so we have kind of, 2, 3 minutes. One thing I really enjoy is this idea of the pivot and kind of leave it on like a positive, inspiring note because basically, you fired the corporate world, and then basically you talk about letting go of your ego and reinventing yourself. So a lot of people, I think they're after COVID, a lot of people took the leap, but there's still some people on the sidelines. So talk about kind of letting go of your pivoting, reinventing yourself, and going all in.
Okay, I'll try to do that quickly. Yeah, it was difficult for me because I was a little older, So the older you are, I was in my early 60s. So, and I had been a big time executive. So you got that little bit of ego going on. When I started out in the business, people didn't care what I did. Well, I had a difficult time, and I guess the best way I can explain, if you're trying to go here, but you're hanging on back here, it's hard to move forward. And I finally had to almost sever my arm to let go of my past so I could move forward and reinvent myself. And I hope that analogy sets with people because that's literally what I had to do. And I want to just say to people who are in my age group, you can do it. You can do it. I've done it. And I spent 37 years in corporate America. I loved what I did. 95% of the time, I enjoyed what I did. I did some meaningful stuff. But I tell you what, 11 years as an entrepreneur, I'm better off financially than I was for 37 years in corporate America. And I'm helping a lot of other people make their financial future bright too.
Yeah. Yeah, that's the thing about just like kind of people are just because they have their identity, their emotions, everything wrapped up in their income and their status and how much their net worth is, and they have it wrapped up in their job and their career, who they are, and it's so hard to let all of that go. I mean, I think that's one of the hardest things. And then the other thing is every entrepreneur I've talked to said they've made more money as an entrepreneur than they did working for someone else. So we need more entrepreneurs. And how can people contact you, follow you, reach out to you, check out your business, etc.?
I'll give you a phone number and a email, or do you want the website? Which do you prefer? Phone number is 602-283-4813. My email is Tom at passiveincomenetwork.org.
Yeah. And for all the audience out there, let's thank Tom for coming on. And it's never too late. You can always reinvent yourself. And again, it's all about the freedom and the ability. And with that, thanks so much for coming on to the podcast.
Chris, thank you so much for having me. It's been very enjoyable. Thank you.